One second. Today, I'm honored to present Mark Ainley to everyone. Mark Ainley is probably the most competent, most knowledgeable person on investing in Chicago real estate. Mark, you have done over 500 rehabs in your career. You've been in the property management in the real estate business for over 22 years. You left your W-2 job. You risked it all when you were 22 years old. You manage over 1,400 units, and you are the host of the Straight Up Chicago Investor with over 400 episodes, which is the main place all investors go to find out about Chicago investment. Thank you for being here.
Oh man, Sam, thanks for having me. I always love enjoying talking to you. So now that we get to record, it's even better.
I get so much every time we talk. I'm just like taking notes aggressively. So this is fantastic for me. Let's talk about the Chicago market for real estate investors as a whole. Just the big picture everyone wants to know is it a buyer's market or is it a seller's market right now?
Well, it's kind of crazy compared to the rest of the headlines we're seeing around the country. There's a lot of doom and gloom. You hear about Florida, the rest of the Sun Belt. Out west, the prices are coming down, or the inventory is getting high. And I can't speak to the entire Midwest, but we're always the last to typically go up or go down in different market cycles. But this has been different. So this is much different than 2008 as far as the rest of the country is being affected, and we're not. But right now in Chicago, it is still a seller's market. And the inventory is super low, and there's just a lot of reasons behind that, including the interest. People don't want to sell their 2.5% interest rate. So anyone that bought in the last 5 years are maybe upgrading to a new house, but they're not necessarily selling the old house, and that is a disruption in the amount of inventory flow from call it one generation to the next. That, and then we've had no new builds here in Chicago or the suburbs, and I say no, but it's very low. If you take a chart of new build permits in Chicago versus Houston, it's crazy. We've been about 10,000 new build permits across the entire metro area since 2011. And if you look at somewhere like Houston, they did like 60,000 last year, 58,000 the year before. It's total goes straight up on an angle there. So the amount of inventory we put in now. That was the opposite back in 2008, where we had so much inventory, and they're building 1,300 unit subdivisions, 15 different locations around the suburbs, in addition to all the infill. So it's just kind of this perfect storm of opportunity, I think. Now, that's going to raise ultimately values and rents. So when I say perfect storm, it kind of works for buyers and sellers right now.
It's actually, I'm really glad you used the Houston market as an example, because I think Houston is one of the only markets that is comparable to Chicago, very similarly sized, although Chicago is a little bigger. And also where the clientele is it brings in a lot of people from the surrounding places more than any other part of the country. Are you still finding Chicago to be a place where a lot of people just move into from Midwest?
Yeah, I think this is where this conversation always goes with college kids. You have a lot of we have a bunch of schools between Wisconsin, Illinois, all the schools inside Chicago, Indiana, Michigan State, all these Midwest schools where one or two of the guys are from the Chicago area, or one or two of the guys or girls gets an opportunity in the Chicago area, and they all say, hey, it's all moved to Chicago, and they might get their first place 2 or 3 or 4 roommates together. Then all of a sudden they start getting relationships. Now you got 2 roommates. Now you got they're all going on their own. And then either they move out to the suburbs, or they move back home where they came from, or somewhere else in the country. So we end up being this almost jumping off point for so many people. And that's what continues to bring people in addition to, especially this time of year, we're recording this in October, November. So many people are starting to come in this time of year for new jobs they might be taking in the new year. So there still ends up being tons of white collar and blue collar jobs here for people to transfer into for.
That's actually the point. I have a lot of friends who are investors across the country, and one thing they are afraid of is the demographic shift that they say Illinois is losing population. Is that Illinois? Is that Chicago? What is your take on all of that?
The numbers are always a little skewed. If you really look at the last 10 or 20 year window, the drop off of population is not that huge. You have a lot of people that move out, but you also have a lot of people that move in. But then also some of those statistics you hear are people moving out of the city and moving to the suburbs. And they do the same thing with companies and careers. Like, oh, Chicago lost 3 Fortune 500 companies, but it's like 2 of them moved to the suburbs. And actually have a bigger plot of land. They actually employ more people out there, and they're consolidating 4 Midwest areas. So a lot of times those numbers are very deceptive in how they're trying to steer reader sentiment, I guess.
Then as a whole, for people that are listening nationally to this episode, what would you say is the pros and cons of the Chicago real estate market for an investor?
So cons, one of the big cons that you always hear people talk about is the taxes are high. I think we're second to New Jersey as far as highest property taxes. But the pro of that is you're paying a heck of a lot less price. And that is usually the offset. So yes, you go to other markets that have $1,000 a year tax bill, but right now you're paying far more per square foot or far more per unit on the multifamily side. The other cons are it is a more tenant friendly government and politics and eviction and different ordinances and rules. But the pro is it's still a first tier market, and compared to some of the other, whether it be just California in general or New York, or even Denver now is getting pretty crazy, Philly, they're far more tenant friendly than Chicago is. So I think one of the biggest challenges around the rules and laws that do favor the tenants here in Chicago is they're very different from place to place. So you could be in Chicago and you have to follow one set of rules. You go a couple miles north into Evanston and you're in a different set of rules. But then you skip another mile to the left and you're in Lincolnwood and you're in a different set of rules. And then there's 182 suburbs around the Chicago metro area, and I think it's like 83 or 84 of them have their own rental license program. So every single city has something different, and the counties, and of course you got the statewide ones that you have to adhere to. So it makes it tough for people to come in and learn. And we've been able to grow as a property management company just because a lot of people don't want to deal with that lift, or they don't want that risk, and we're able to help them. But yeah, I think that's a couple of the pros and cons.
Yeah, and I like that you brought up the tax bill. You manage my properties, the tax bill and the price point. In Chicago, it's very possible to buy really affordable places. Like I bought this condo 4 years ago for $93,000. You manage it for me. It brings in almost $1,500 a month in cash flow. And the tax bill on it is like $2,500. So super high tax bill for the price, but I don't think I would be able to buy a $93,000 condo in a good neighborhood anywhere else in the country, like a major city like this, and get cash flow that I'm getting with it right now.
Yeah, walking distance to one of the best water features in the world. Like that whole pocket north of the city there, Edgewater, Uptown, Andersonville, Rogers Park. Like I still think I'm popping on to maybe a future question. I still think the real estate is so undervalued there, and the rents are still low, and has room for investors to definitely have opportunity with.
Let's take it there. So let's say you're an investor and you've decided that Chicago is actually the place you want to go. What do you see as the best value for those people? And you can say for what kind of investor and what kind of investment.
Yeah, I think there ends up being a couple different layers of risk tolerance people might have. I think an easy way to come into the market affordably is to go into a building that is maybe on the far north side that has an HOA that covers, all the outside. You're only having to worry about the inside, and it's a little more structure for you. So that's obviously the easiest way. Now, that also, on the opposite side, HOAs can be a pain. They I'm not a big fan of them these days just because I've been burned a few times. And then you have what I think the suburban market we have here is for single family homes is just huge in itself. And I'm not talking a lot of these turnkey providers and investors are all buying in the south side, south suburbs, and they see these sexy cap rates and all that. And there's a lot, and that guy was going to that as well too, of what people don't recognize that. But those aren't the true gems to invest in here in Chicago. You look at the cost to build a new construction house in the suburbs, and even not even like the nicest suburb, right? You call it maybe a B class suburb. It's costing $600,000-$700,000 right now. Now you can still find a single family ranch mid-century built for maybe have to do a rehab, but all in maybe 350, and that's your starter home now, and that's what people are renting, and there's not that much of that inventory. And if you think about this, you've probably heard the notion you never want to be the biggest house on the block. So now you're buying the one of the smaller valued house on the block, which all the new construction, the pricing, it's not even necessarily land, it's how much it costs to build these buildings. And they can't build these buildings small anymore. These builders, even the cookie cutter ones, the bigger they build, it incentivizes them to build 3,500 versus 2,800 even, which 2,800 is still huge compared to the last 100 years. I grew up in a 875 square foot ranch, and that was big to me, and that was normal, right? But that's what you turn around and invest in now in these neighborhoods, and I definitely think there's a huge opportunity for that to grow. But then one more kind of front there, I think the best opportunity Chicago has is for house hackers. A house hacker is somebody that buys a 2, 3, 4 flat property. They can get FHA financing, or they can get conventional for 3.5% or 5% down. The ability to make your money stretch the most is here in Chicago. Chicago has more 2 to 4 unit buildings than any other city in the country. And I think I saw some crazy stat about they have more in Chicago than like the entire Midwest combined, adding up to that. But the opportunity for a house hacker to come and put such minimal down and exercise, their owner occupied, they'll live in one, they'll rent out the others and get growth. They'll get rental growth, and they'll get property value growth on an entire building with so little out of pocket. And I think that's one of the bigger ones. Now, you can't go find that in a suburb, and that's getting more expensive in some of the nicer neighborhoods. So that is a challenge to work with the right broker or be on the right team to be able to find those type of opportunities where you can maybe live in one unit, not maybe pay full market price, and still be able to cash flow on the rest of it.
You said 4 things that I really picked up on, and I want to make sure I understood them correctly. They were so good. Number one is a lot of people see the South Side's cap raise and they think it's sexy, but I understood that you said the reality of it is different. It's actually not as good as it looks. The second thing, the opportunities said, is actually just on the north side of Chicago. There's a lot of great opportunities, hidden gems like Rogers Park, Uptown, Andersonville. You can find some great opportunities there. The third one was single family homes in the suburbs that are the starter places, like those like $350,000 to $600,000 single family homes that is places a lot of people rent right now and will forever continue to rent. And then finally, and the biggest thing they said is house hacking, especially for people that are probably in their 20s and 30s, where you can buy 5%, put with 5% down. And it is, my friends are buying like $600,000, $700,000 2 flats, which is pricey, but you're getting 2 units in Chicago, again, 3rd biggest city in the country. And they're appreciating like crazy right now. I see them going up by like 5 to 10% year over year for the past 4 years. Anything I said wrong there, Mark?
No, definitely not. I'll just point out the sexy cap rates that out-of-state investors see. They might see 10, 12, double-digit type returns. In the end of the day, through my experience, those end up being closer to 7 or 8% type returns, if that, due to just kind of high cost of maintenance. A lot of those end up being Section 8. We have additional layer of costs. A lot of them are around rental license programs. We have to deal with that cost. And then the turnovers are just more expensive. I just put an article out on North Side versus South Side turnovers. So you can check that on our blog. But when you go buy these, call it starter homes in the suburbs, you might only make 4 or 5%, but it's much less of a lift, much lower stress. You don't have the ups and downs. A lot of people buy these out-of-state properties, these turnkey properties, thinking they're turnkey, called armchair type investments. And no matter what, even if we're managing your property and a south suburb and we're doing everything we're supposed to do, there's just so much stuff that goes on. We're always bothering you with stuff. We're still going to be telling you, hey, listen, we got the rental license. It came out. We got to do these $900 worth of work. Can you put money in? And we're following everything. We're doing everything as efficiently as we can. The Section 8 it just came out. They said we failed on these 12 items. It's going to be $700. We'll charge you 10 back for 200 of it, but man, 500 of it, technically you're going to have to fix that outside awning that's falling off. And then it's like, all right, the neighbor drove through your fence and doesn't have insurance, so you're gonna have $2,500 to fix that fence. And So you end up, we handle everything for these type of clients, but it's a heavy lift, and it's definitely not turnkey mentally.
Yeah, and I will put a plug in for you. I've worked with probably 4 or 5 different property managers between Massachusetts and Illinois, and you guys are the only property manager when something goes wrong, it's like, hey, this went wrong. Here's the solution. Here's the cost. Can we do it? Whereas every other property manager says, hey, this went wrong. What do you want to do about it? I'm like, I pay you to tell me the solution. I don't know. So I will put the plug. You guys really do like update really well. You do give the solution and you do the heavy lifting, but the mental load is very real for a landlord, no matter the property. It's still a large asset that we own.
Yeah, no, we try to train, I've been conditioned to this as an investor, but most of our team owns investment properties, but there's a handful that just don't, and helping them understand that gut punch email you get saying your hot water heater went out. We all know it's 20 years old, and you all know it's going to cost $1,800 or $1,200, whatever it is. But getting that email on a Friday morning when you already had something bad happen the night before that cost you money for your kid or whatever, like those hurt no matter what. And it's just like trying to make that approach as warm as possible and work with you as much as possible. Like that's real. That's real for landlords.
Oh, it's so real. And when something goes wrong, everything goes wrong. So it's never like a little thing. It's always everything across all properties going wrong at once. What do you, if you...
Can I say one thing about that? Because I think it's important.
Oh, please, yeah.
To reflect on. I think there's 2 types of investors, right? There's 2 types of people that get into real estate. I'll word it like that. They might never make the true definition of investor, but I think being a real estate investor is very entrepreneurial, and entrepreneurs tend to have a more optimistic outlook. You made the comment of when one thing goes wrong, everything goes wrong. I think there's 2 ways to look at that. It's like, all right, these are out of the way and I won't have these problems next year now. Like now that I spent it, I wrote the check. And then there's the other like, oh, this is not going to cash flow. I can't afford this. And I think I'm going to sell when this tenant moves out. And I think the 2 are they're dichotomies of each other. And I see the optimist, the entrepreneurial type person. They're the ones that really thrive in real estate investing, and the other person that it's like I just can't handle it. And some people can't. Like they either have to find a business partner that maybe can offset some of that stress or build in some of that optimism, or they need to invest in very conservative type assets if they're going to stay in real estate. So I see a lot of these very that second example, trying to invest in high risk D-class type areas, is like, man, you're not built for this. So I think what my takeaway is there is like understanding your risk tolerance is probably a good umbrella for that, but just understanding what affects you, what makes you happy, your quality of life, and what type of stress you can handle should play into where you're going to ultimately be investing.
That is so timely, because I've been a landlord for a decade now, and this past year, like winter of 25, was probably the hardest stretch of being a landlord I had. I had 2 tenants just stop paying. 1 tenant just got up and left. Like one text just said, I'm out. And then I had vacancy. I had a vacancy, and like they destroyed the place. And this is just like 3 of them. And at the same time, I was actually living abroad. This was like, I'm going to live abroad. I got everything set up. I'm going to go. And it was so tough. And this is timely for me to hear, because I was for a long time in the camp of, you know what, let's just like sell these properties. I'm tired of being a landlord. But you're absolutely right. You can also look at it saying like, I just dealt with it. So if law of averages or anything, I'm good for another like 10 years of pure cash flow and growth.
I'll share something else. And again, I think this just is something that can resonate with people out there is, when the market crashed, I didn't get burned as bad as a lot of people did. Don't get me wrong. But for me as a late 20s, trying to start a family, I got stuck with 3 properties. And those 3 properties, I had to come out of pocket. I think it was about $1,100-$1,200 a month. Roughly, it's like 1183. I remember the exact number. It was painful, right? So 1183 a month, and I wasn't making much money back then, and or actually the money I was making, it was going back into the company. Like everything was like, do I hire someone or do I do this? Like those were the decisions I was having to make. But I didn't want to destroy my credit. I didn't have an easy out as far as short sale or even workout plan. So I was stuck with it. And that killed me it took me probably about 6-7 years of that 1183. So if you think about that, that's about $60,000 that probably, it came out of pocket above and beyond. But I look back now, those 3 exact properties, I have over $400,000 in equity. The mortgages are 2/3 of the way paid down. I've gotten tons of tax write-offs. That 1183 or whatever that was out of pocket. I was getting write-offs for that every month, even though it wasn't in my pocket or wasn't coming out, putting money back in my pocket. In theory, it was still helping something else I was doing. So, looking at that years later, like that's what a lot of people contemplate. They contemplate the now, and it's really how you're going to feel because, the property values they're at today, going through the 2008 downturn. I would have never thought they would be here. And they're actually not even that crazy. Everything was so low at that point. And that's when you can only see kind of the outside. You can't see outside the little box you're in at the time. Like, I just thought like, this is like doomed forever. So, but yeah, super grateful I held on. And I think I just want to share the message that, a lot of people are like, oh man, if I'm not making $700 a door for cash flow, I'm not going to buy it. It's like, man, that's not, you're gonna waste so many great opportunities of maybe not hitting as much cash flow and losing out on the other 4 benefits of real estate investing that you're gonna hate yourself 20 years from now.
I 100% agree. My best performing property, I've made so much money just on the appreciation. Like I put 5% down. I actually bought it with FHA 3.5% down. I bought it for like 370, and I could probably sell it off market for 720 today. And at the beginning, the cash flow was minimal. Like if anything, I mean, because I was living in one and everything, but still, like even if I wanted to rent both units out, I would barely break even. But I don't know any other asset where I put literally like $15,000 down and get $370,000 back in 8 years.
Yeah, I love that whole concept of, you buy $100 worth of stock and it goes up 10%. You have $110. You buy $100 in real estate with a minimum loan, it goes up 10%. Like it's a crazy
your money, man. Mark, what would you work with hundreds, if not thousands of landlords and investors at this point in your career. What would you say if you could create the perfect investor in your vision? What would that investor look like and what would they do?
Well, I think the perfect investor starts with someone that's super decisive. And I had a presentation recently and I had a whole chart for this, but if you look at kind of a linear chart of deciding something's the right thing for you, deciding that, or learning about something that's right, deciding that this is what I want to do, and then actually doing it. Those three, the timeline, the time in between those 3 points, the more successful people have limited time in between those. I mean, it could be weeks or months versus decades for people. I have a couple buddies that in the 20 years ago now, right? 22 years ago, where I'm gonna get into real estate and I'm excited. And I talked to one of them the other day. He's like, yeah, I'm still thinking about getting my license. It's like, man, like you're done, dude. Like you missed the boat. Keep plowing that 401k and your corporate job and just ride this one out, man. Like I didn't give him that advice, but at that point, it's like the missed opportunity he had. So the perfect investor is able to be decisive. We kind of talked about it right now. There's a lot of rolling with the punches. The whole. I love the line. It's not how hard you get punched, it's how hard you get punched and get back up, right? And the whole tenacity concept is huge in this. So those are some of the attributes that kind of make that perfect real estate investor. But I think the ultimate, I think where a lot of real estate investors miss the boat is what they're trying to accomplish and what they're chasing. So you get a lot, and I did this myself. It's like, I'm going to get 100 properties, and that was like early Mark, and I'm going to get 100 properties, and I'm going to be the biggest landlord in the shop, or whatever it might have been. But I had this big number, and it's just a made up number, right? People might say, I want 1,000 doors or whatnot. It's like, what are you chasing? And a lot of people are chasing this financial freedom thing, but you start growing a company that big, you all of a sudden you're running a company versus even something you can outsource to a manager because it's so big, where it's like, we had somebody on the podcast a couple of months ago, and they're like, they kind of were explaining a similar situation, and it resonated with me. And basically, they did the math, and they're like, yeah, all we need is like 17 doors, and just aggressively pay those off, and we'll have a further life than we ever could imagine. Like, so the how much you really need versus how much you're chasing, and if people realize they only need 15 doors or 17 doors, and they put all their energy into figuring out how to pay those down faster versus trying to go after 100 doors, and they're making bad decisions, and they're not operating efficiently because they're going after the superficial number. I think so. Understanding people's what you're really trying to accomplish, I think, is something that really helps an investor be a better investor.
Being decisive was one thing. The other thing was really understanding what the goal and the vision is and how it's serving you, and then doing the math of like kind of working back from that. Not just one made up number of 100 units, but really what does life look like, and what life do you want, and when you get there.
Yep. Beginning with the end in mind, I guess, is the summer.
I love it. And and one thing you said that I appreciate is kind of like paying down those properties. I have friends that have a lot of units, like 30, 40, 50 units. And they're always thinking of like, oh, why would I ever pay off debt? Like, it's good leverage. And for people who are going to listen to this podcast that don't know, I'm actually a loan officer. We help 100 families every month, and I hate debt. I tell people, like, my job, I'm giving you this debt, but my job is to help you pay this down, pay it off as soon as possible. I think in real estate, it's just like the real value comes at the end when you have that cash flow, if that is the part that you want. So there's nothing wrong with paying off debt, just getting to enjoy the fruit of the labor, the cash flow, the things that you built, and living life at the end of it all. Like, it's supposed to serve our personal life, not just be our life. That's just my personal take on it.
Yeah, no, I can't agree more.
Mark, I want to talk about GC and what you've built as well. I'm one of your clients. You have a lot of clients here. At this point, you are the biggest property manager in Chicagoland area, right?
We're one of the top 3 biggest scattered site. Obviously there's the guys that do all the multifamily and they got 10, 12,000 doors. But when it comes to scattered site management, we are one of the top 3. And
what's been your secret to growing this big? What, in terms of like the experience you want to provide to your clients?
It's I've had a turn in my thought of how I approach, what we're selling, right? Every company has to like, what are you actually selling? And the past, it used to be, we're going to help you, and maybe I might try justifying we're going to save you money, or we'll make up the money for you in different decisions we make and offset that cost. And when you do it that way, you leave people they have to. It's very it's hard to see that value or get everyone else to see that value. And what I came up with kind of recently is really where we serve our clients best is really buying back their time. And their ability. So we always say it takes about 20 hours to manage a unit on a non-turnover year, and it might take 60 to 80 hours on a turnover year. And if you look at how much you pay us on a monthly basis or on an annual basis, call it $150 a month, $1,500, $1,800 a year. If you're able to get that type of time back, and you put that into something else, like you're a loan officer, man, you can make far more getting one deal done than having us in that 20 hours that you're going to get back from having us with your property versus doing it yourself. Like, there's such a huge opportunity cost that everybody that we manage for, everyone, myself included, everyone that I come across in this investor world, the opportunity cost, and we step over. How's the saying go? I love the saying. We step over dollars to pick up pennies.
Yeah.
And so that's the first thing. And then we talked earlier, I think the other thing that we appeal to people for is just risk. We talked about how difficult all the laws and interpreting them and what applies where. Like, we've became masters of that in all areas, and we're able to take that risk away. So buying your time back and lowering your risk is really what this company's evolved to doing for our investors.
It's absolutely true. And I can attest to that. Was it 20 hours to 60 hours per month or per year?
I'm sorry, per year. So 20 per year for a non-turnover year, and then 60 for 60 to 80 for a turnover, depending on how big the turnover is, how many times you got to show it, and so forth. So, and that might even be that's average. So,
And I think I would also add a peace of mind, at least for me, knowing that my risk is lower and I don't have to be involved in that time, because it's not just like 20 to 80 hours of work. It's a lot of bandwidth that goes into doing the 20 to 80 hours as well. You have, like, for example, if I wanted to lease my place out, I would have to go learn how do I actually, like, what are the regulations? Where do I go get a lease? Where do I post it? How much should I charge for it? It is a lot more work than just the physical labor of those things. So absolutely true. How have you set up your company to deliver that experience and those values to your clients?
We have our core values, and I think the core values that I think help with the most is responsive. We trademarked Chicago's responsive property manager a few years ago, and we did that on the heels of not just necessarily a sales pitch. We're like, we're already doing this. We're already, one thing that people are always like, how'd you get to this point or whatever? That's always a question. And I'm just like, well, I answer my phone. I get back to my emails and I make sure my texts are done every single day. Like, right. Like it's like you communicate, you're responsive, you solve problems, especially in this industry. Whatever happens or doesn't happen today affects what happens or doesn't happen tomorrow. So, just if you got, I'm just from the whole school of just, if you got to touch it and it takes less than 2 minutes, just get it done right there. So that the whole responsive piece has been huge for us. And then GSD, we made that one of our core values this past year, get shit done. And we were hesitant. It was something we always said around the office. Where we're like, swearing. What if that turns off people? It's like, what? If people are offended that want to come work here or work with us about us wanting to get shit done, then we're probably not. We're gonna probably butt heads on a few other things too. So let's be real. Let's be who we are. Let's be authentic. And we added that to our core values. And those two things have been huge for us.
Those are great values, and it is true. Like the get shit done part is, there's no passing the buck to anyone else. Like I said, my experience has been that if there's something wrong, I get an email, I get a text, and I get a call saying, here's what went wrong, here's the solution, here's how much it costs, can we go in and do it? That is owning the problem and not passing the buck to someone else and just getting it done. Is there an ideal client that works well with you guys, that can like really succeed? And is there someone that just wouldn't work so well with you guys?
So a couple, we have kind of criteria for what the ideal client is, and one of them ends up being, it's willing to pay for property management service, and that kind of goes back to seeing the value in it, right? What are you getting for the value? Because obviously this is another expense on your line item when you're looking at the return of your property. So if you can't see the value, then it's usually not good. And then kind of tied to that, which is usually the same personality, is the person that doesn't want to give up control. And I'm talking with a guy right now. I love the guy, but it's like his like lock on his back doors wasn't working, and when we went to the quality control for the turnover, it's like we fixed it. And when we did one other thing that just was like a safety thing, it's like it was like $150 or something like that. And I'm going back and forth with this guy like all day yesterday. It's like, man, like to the point where it's like I'll just pay for it, man. But it's like ultimately like he's probably not going to be a good fit for us long term, because he's just going to wear us out. He used a couple words in his email to me this morning. It was appalled, and he used another word. And I basically replied back. I said, man, using these words, appalled and blank, makes me feel like we are not on the same page here. So those are kind of the like, he was appalled over $190 of like fixing his lock. It's like, man, it's a safety thing. You have a $600,000 house here. Like, you just got to fix the stuff that's got to be fixed. So giving up that control piece is a big part. And he was a home owner, owner occupant, but some investors are like that's their identity. They tie it to their management of their properties, their how everything happens on a day to day, and they can't let that go. So we try to talk people through that and lay out the expectations. And we've gotten really good at that over the years to make sure, because here's the end of the day. we don't want to work with the wrong people just as much as the wrong people don't want to work with us. Like it's a win-win, and no different with our employees too. Like now at the end of our interview process for employees, we have an expectations call, which I lead up, and it's basically me trying to talk you out of not wanting this job, like telling you how things are not going to be easy, and this is your like, and our and people that made it here have these couple like, are you comfortable with that? Does anything make you feel weird? Like we try to make sure that we're not. And again, it's for them, it's for us. It's a win-win, man. If we could part ways early on versus doing the brain damage to each other and leaving on not good terms. So
it's I'm glad you said like who's not a good fit particularly, and you really focused on it. I have a saying that my job starts when you come and work with me. It doesn't end there. So most people think we're just like trying to sell them and say like, hey, come in and then we're good and we're done. It's like, no, my job really, and your job really starts when people start working with us. So we're better off just being like, hey, is it going to be smooth and happy for both of us, or is it not? And if it's not going to be, let's just not even go there because it's not worth it for you or for me.
Yeah, exactly. Time's too short, right? We all have the same amount in a day. It's like, and it ends up being, you know, we kind of have this thing around the office. Like if someone emails us or we see on the call ID and they call us and we cringe or we don't want to answer it, it's more like there's issues. Either A, we haven't done something we're supposed to do. That's the first one. Or B, this is maybe a relationship that we're just not on the same page with that we have to deal with versus kicking down the road. So
that's a good rule to have, I think, personally.
We all have family like that too, but you can't get rid of them.
For you guys right now, if someone wants to reach out to you and wants to work with GC, what is the best way for them to reach out, to find out more, anything like that?
Oh yeah. So on our website, we have a bunch of different forms you can fill out or calendar links to schedule directly with me personally. And then also I over on Instagram, it's Mark Ainley, REI is my handle. So you could DM me there. I'm on there every day.
Perfect. It will all be in the show notes as well. Mark, final question for you. If you could share one thing with investors, can be in Chicago, can be across the country, can be international, whatever it is, about Chicago market investing here, what would it be?
There's so much opportunity in Chicago, and it really takes a lot of the locals to really see that, whether it be different pockets, different neighborhoods, different suburbs. So I think if you are in the Chicago market, you have such an advantage. And if you're outside of Chicago, finding those local that are willing to share that knowledge. And I always say there's almost a moat around Chicago for real estate investors. It's like, all right, you can go invest in the south side, south suburbs, but you know, we're going to keep all this stuff secret here. So if you're willing to work with somebody, or you're able to find somebody that is willing to kind of help share their network and the resources of these pockets and go in depth of things we've talked about here today, like that's the ultimate plan. But then the people in Chicago that are here, man, just taking advantage and doubling down on what you have here in this opportunity. And I'll say one more thing. Us as property managers, we have a nice little moat as well too, because these nationwide companies, these national property managers, they struggle to succeed here just because of all the intricacies of the different markets and the rules that we talked about earlier.
Yeah, that's really good. That's a great place to end it. Thank you, Mark.
Thank you, Sam. I appreciate hanging out with you. It was an enjoyable conversation. So thanks.